a $12,000 car, a $29,000 payoff, and the bank never told you why. Stay till the end. There's one hidden number that decides everything before you even sign. Buy here, pay here. BHPH means the dealership isn't just selling you the car. They're also the bank. No outside lender, no credit union, no credit check. Just the dealer, financing you directly out of their own pocket. Sounds convenient. It's not built to be convenient. It's built to be profitable for one side only. The Federal Reserve found that BHPH dealers have widened their customer base over time. Deep subprime borrowers made up 70% of their loans in 2018, but just over half by 2025. This model isn't shrinking. It's spreading to buyers with average credit too. Here's where the math starts. A car with an actual market value of $12,000 gets sold by a BHPH dealer for $18,500. That's a $6,500 markup, a 54% price increase before a single dollar of interest is calculated. You haven't even started the loan yet, and you're already paying more than half again what the car is worth. Now add the financing. Industry reporting shows BHPH dealers typically charge around 25% interest, above even standard deep subprime rates elsewhere. Finance that $18,500 at 25% APR over 48 months, and the monthly payment lands around $613. Multiply that across 4 years, $29,443. Total money out of your pocket for a car that was worth $12,000. You paid 2.45 times the car's real value, and that's still not the worst number. The 25% APR is what's on paper, but that rate is calculated on the inflated $18,500 price, not the $12,000 the car is actually worth. Strip out the markup and ask, what interest rate on the real $12,000 price would produce that same $29,443 total? The answer comes out to roughly 54%. 54%. That's the number nobody puts on the contract. That's the number this video opened with. Compare that to a credit union loan. Same $12,000 car, no markup, 8% APR, 48 months. Monthly payment, around $293. Total cost over 4 years, $14,059. The gap between the two paths, $15,384. That's more money than the original car was worth, lost entirely to how the loan was structured, not the car itself. Many BHPH contracts don't bill monthly, they bill weekly. That $613 monthly payment becomes roughly $142 a week. Sounds more manageable? It isn't. A monthly borrower has 48 chances to miss a payment over 4 years. A weekly borrower has 208 chances. That's 4.3 times more opportunities to fall behind, and every missed payment moves you one step closer to what's coming next. Here's the twist most people never see coming. For some BHPH dealers, repossession isn't a failure of the business, it's part of the business. The Federal Reserve found that roughly 5% of BHPH loan balances were in active repossession in late 2025, compared to less than 0.5% for traditional auto lenders, 10 times higher. Separately, Fed research shows BHPH delinquency rates run about 2.65 times higher than traditional lenders. When a dealer repossesses a car, they don't lose the vehicle, they resell it, sometimes to another buyer under another high markup, high interest contract. The same car can generate profit 2, 3, 4 times over. In January 2025, the CFPB secured a $42 million judgment against a Georgia-based BHPH operator for illegal repossessions, misuse of remote vehicle disabling devices, and failing to issue gap insurance refunds. That's one dealer in one state. Zoom out. More than 3 million vehicles were repossessed across the U.S. in 2025, the highest level since the Great Recession. Auto loans 90-plus days past due climbed from 3.8% in early 2023 to 5.17% by the end of 2025. Multiply those 3 million repossessions by the average negative equity carried by trade-in buyers, around $7,183, and you get an estimated figure north of $21 billion moving through the US car market in a single year as negative equity. That's not one bad decision. That's a pattern playing out at scale. Before you sign anything, ask for the cash price, separate from the financed price. If the dealer won't separate them, that's your answer. Get pre-approved by a credit union or bank before you walk onto the lot. It gives you a real number to compare against. And if a contract mentions a payment disabling device or GPS shutoff, walk away. There's usually one more layer most buyers never notice. Many BHPH deals bundle in gap insurance, extended service contracts, and paint or fabric protection packages, often marked up 2 to 4 times what the same coverage would cost bought separately. A gap policy that typically costs a lender around $200 wholesale can appear on the contract at $800 or more. Roll that into the loan, and you're not just financing the car, you're financing the markup on products you may never use at the same inflated interest rate as everything else. That's often another $500 to $1,500 quietly folded into a monthly payment that already didn't add up. Ask for an itemized breakdown of every add-on, gap, service contracts, protection packages, and whether each one is optional. If the finance office won't let you decline something, that's not a requirement. That's a markup. The system doesn't need you to fail on purpose. It just needs you to not do the math. Thanks for watching, and I'll see you in the next video.